All right, so here's the bear point. So everyone today, if you don't know him, you're going to be introduced to a guy named Stephen Diggle Volps. Okay. I'm just going to read from this. Let's read from this. It's a quick read. Let me read through this and then we'll keep going from there. Okay. So it'll take me like 2 minutes to read through all this, but then we'll analyze it. This is from Bloomberg. A former hedge fund manager whose firm has made billions of dollars during the global financial crisis is ready to pounce on volatility again as he sees threats to market stability at a level not seen since 2008. Steve Diggle's family office Volps Investment Management is seeking up to $250 million from investors as early in the first quarter, the Oxford, UK-based investor said in a telephone interview. Diggle, whose firm made $3 billion between 2007 and 2008, is raising the money for a hedge fund and managed accounts designed to generate hefty returns in market crashes and profit from wagers on rising and falling stocks in calmer periods. Pretty much the same thing that he did in 2008. The idea to start the new fund came after the firm developed a model to use artificial intelligence to read large volumes of public information. This is really interesting. It helped spot Asia-Pacific companies with a high probability of blowups due to risky behavior such as high leverage, asset liability mismatch, or even outright fraud, Diggle said. The equity portfolio will also have single stock or indexes as bullish wagers. Diggle is making his biggest push into volatility trading after the March 2011 closure of his predecessor firm, Treatise Fund Management. The then Singapore-based hedge fund firm saw assets swell to nearly $5 billion in 2008, bolstered by profits from bets on market routes and bank troubles, only to later fall victim to a turn in markets brought on by unprecedented central bank intervention. So he made a lot of money, and then the banks intervened, and that kind of took away a lot of his money. The number of fault lines out there today are greater, and the chances of something going wrong are significantly greater, but risk prices have come down, Diggle said, drawing a comparison with conditions under more than a decade of easy monetary policies. So we are kind of in an analogous situation to where we were in 2005 and 2007, meaning 2026 would be 2008, and that's when we would have a crash. Among the potential flashpoints are the stretched valuations of U.S. stocks, the country's prime office market glut, elevated federal debt, and tight credit spreads. A new bull market generation of traders who entered the industry after 2008 have driven a small group of U.S. technology stocks and crypto to dizzying heights, Diggle said. Meanwhile, it's cheaper to buy instruments to protect against routes. Basically, it's cheaper to go short than it is to go long. And if you're correct on your short massively outperforms your long. And Chamath even said this on the Olin podcast, that he would rather be short the economy than long the economy for the next year. Elsewhere, he cited mounting geopolitical tensions and China's shadow banking woes. Retail punters, the growing might of passive investment funds, and high-frequency traders will likely exacerbate routes like they did in March 2020 and August 2024, Volp said in a marketing document for the new fund. Final part of this article. Treatise also amassed at one point credit default swaps with more than $8 billion of notional value on the very banks that it sold it to, those tail risk derivatives. It was used in part as a hedge against the bank's inability to honor their obligations if markets tanked, and in part as wagers on the lender's poor risk management. The Lehman Brothers CDS settled at a 367-fold the price that Treatise had paid after the bank filed for bankruptcy in 2008. Meaning they made 367x on their money, while the same instrument on UBS Group AG generated about a 20-time return. Hedge funds that purely bet on rising volatility tend to lose money during the calmer days of the market because volatility doesn't go up as much. Since Treatise shut down, Diggle's family office has invested in avocado orchards in New Zealand, real estate in Germany, a biotech company in the UK, and stocks that could benefit from European rearmament following the Russia invasion of Ukraine. So pretty much everything except tech companies in the United States. While Volps toyed with volatility trades occasionally over the years, it didn't make a serious effort at it previously, partly because of the absence of trading opportunities that could help offset such losses. Diggle said the capital structure arbitrage trades that Treatise used to subsidize tail risk bet losses in its early years have become less profitable. So the point of all of this is that this guy, Steve Diggle, which I know you guys are having fun with that last name, but Steve Diggle, who's also an English musician, if you didn't know that. It's not like I just Googled that, but if you didn't know that, then there you go. Steve Diggle, this is the guy who made $3 billion in the housing market crash as he shorted it. I think Michael, I don't think he was part of the Michael Burry group of people that ended up shorting, but he shorted it from a different perspective. He's now saying, hey, maybe we come back and we start thinking about where valuations are currently in 2024. Now, here's my thoughts on this. I read this article a couple hours ago, and I think it comes back to the same bull-bear debate that we're going to have in 2025, which is as follows. Is AI real? Is there an ROI from AI? Will companies keep spending to show that ROI and to build out the CapEx infrastructure for the ability to eventually show that ROI? And then will that reflect in earnings growth leading to justify the valuations that we have right now? If that's the case, and even if there is a 10 or 15% correction because NVIDIA, Amazon, Meta, they don't have the best quarter, is that a 2008 housing crisis? I mean, I don't think so, right? Like, it doesn't feel like a housing crisis. Is AI that big of a bubble? I don't think AI is a bubble at all. And even if some valuations are stretched, I mean, we've had this debate for so long in 2024. If it's not a bubble, then there's no collapse. It might be a bit extended. You might see valuations come down, but that is not a 50 to 70% crash in the entire market because the market's propped up on this thing that's just not real. Like if you believe AI is real, then the market's propped up on something that's actually reasonable, which is revolutionary technology that's happening. Now, one thing that it was in the article was that they use, ironically, they're bearish on tech valuations, but then the firm, which is raising $250 million, used artificial intelligence to read large volumes of public information. So it's like they're using the thing that they're kind of bearish on in terms of valuations to then come to the conclusion that Asia Pacific companies are all frauds. That's essentially their point. I don't know how good those AI models are. I don't know how good that information is. And I don't think every Asia Pacific company is a fraud. Are there a lot of problems with some of these Asian Pacific companies in terms of how they report? Of course. Like that's been true for the past decade. Does that mean they're all fake and that they're all highly levered and they're all lying about their earnings? I don't think so. I mean, some of them might be, but I don't think the majority of them are. And maybe I'm wrong. Maybe their AI model is super smart and figured it out. But if that's the case, and you go short the Asian markets, does that cause some cataclysmic collapse in the United States? Probably there is some level of correlation. Is that the housing market again? I don't know. So look, as I'm reading this report, like there is an argument for why I understand why he wants to get bearish. I mean, in general, everyone is bullish. Markets are up. You're seeing stretched valuations. I get it. Does that mean you go and say 2026 is going to be 2008 and 2023 to 2025 was 2005 to 2007? I don't know. I think there has to be a much, much bigger evident bubble, which is hard to see because obviously that's the whole nature of bubbles, but you have to have a little bit more logic on it to come to that conclusion. Now, here's another macro argument for why we might not be in that big of a bubble. If this 10-year is topping out and this 10-year is coming down, and then this 10-year, as a result of coming down, gets mortgage rates to come down, which unfortunately mortgage rates are not coming down yet, and we need them to come down, then yeah, we are going to see equities get even more momentum because $7 trillion on the sidelines is not going to take 3% from a money market fund. They're going to start to pile into equities. And if they're piling into equities, that means there's going to be a bid on a lot of these names. If inflation comes down, the market's going to get excited. Will that have potentially some issues with unemployment and rates? Yes, all that stuff is there. But are we setting up from a macro perspective to have a massive 2022 collapse like Dan Niles was talking about today in terms of cash being your best friend? I don't think so, only because I think inflation is coming down and because I think unemployment is not going to get affected as dramatically as some people may think. Again, we would need inflation to get back to 6, 7, 8% for us to really be like, holy crap, it's Volcker 1980. Jay Powell's got to come back in. He's got to save the market again because he messed up thinking that he was done at 2.7%. I just don't think we're there. I don't think the data says that we're there. Shelter data doesn't say that we're there. And so if we're not there yet, if the macro doesn't have a massive bubble and AI doesn't have a massive bubble, then where is the massive bubble that he's looking for? Now, granted, there might be a bubble. It's hard to see a bubble, so I have to be humble enough to know that there might be a bubble out there that I don't see. But that is one of the bears from 2008 that's coming back. Maybe it's kind of bullish too that the bears from 2008 are coming back because they're getting so determined that this is finally the start of this massive bear market they've been hoping for. And then, that might just not ever happen, and it might kind of be this perpetual hoping of a bear market to play out. But I'm much more on the side of Tom Lee and Dan Ives, which is that tech is real, tech is compounding, and the macro will give you great opportunities to buy the dip. But for the next couple of years, there's not necessarily a headwind against the United States economy that can't be figured out via what Jay Powell has been doing, which he's been doing a pretty damn good job, and something that technology can find a way to mask. I mean, if ChatGPT did not come out in 2022, yeah, we probably wouldn't have the bull market that we're having right now, because you can't have rising inflation and rising rates, but somehow the market came up. That's what the bears are really mad about. How in the past 2 years did the market go up with all this inflation and all these rising rates? Because of AI. And now that all this stuff is coming down and AI is only getting better, you have a recipe for at least somewhat of an interpretation that we could have a pretty bullish next couple of years. So that was one of the bear articles that I wanted to show people that I saw today. I thought that one was a bit more of an interesting one. NVIDIA event tonight is at 9:30 p.m. Eastern Standard Time. That's going to be a big one. I'll be streaming it live with Jose, and we will just be discussing what's going on with NVIDIA. Christian, thanks for the $5 super chat. Hey, I have an idea. I'm going to use AI to discover that AI is fake. Please send me 250 billion. I think he's going to end up raising the 250 million that he's looking for. And he's probably going to go short. And maybe that 250 million returns really well if we have like a little bit of a meltdown. But 2008, that was again, it's called a great financial crisis for a reason. Like, people lost their jobs, companies went out of business, stock market took until 2013 just to reach the heights that it was at 2008. Like, it was tough. We had to have massive stimulus when Obama came in. Like, it was not pretty. So whenever someone says we have another 2008 coming up, they are implying shit's about to hit the fan. And it's like, if you think things are going to get that bad, you better have a hell of a reason for why things should get that bad. Because if not, then, maybe there's not going to be something that bad to look forward to. A 10% correction absolutely could happen. We have one every single year. Historically, we have one every single year, every 13 months or every 14 months. And 2024, we had it as well. It was August 5th. It was very quick, but it happened. So we'll probably have it again this year. But does that mean, 30, 40, 50% direction? Did you feel the downturn of 2008? So one thing the article was good about is that he is saying that there's a generation of people who have not lived through 2008 that are now investing. I am obviously included in that generation. I can't speak to how bad 2008 was. Thankfully, my parents weren't invested in the market, so they didn't see like their net worth disappear or anything. My mom was a teacher, so her job was fine. My dad owned a liquor store. His business was fine, even though there were some struggles. So my family didn't feel the brunt of 2008 because my dad had his own business. My mom was a government worker, so it wasn't that crazy. But granted, I mean, he is right about that. I'm someone who has not experienced a real market meltdown. I guess 2022 was kind of a market meltdown, but it was so temporary, like it was just like, all right, it was a year and then we rebound. 2008 was like years before there could be any rebound. So yeah, that's fair. I haven't experienced a type of crash like that. But even without experiencing a crash, I'm looking at the market all day, looking at data all day, trying to do the best I can. And when you put all the data together, especially just the hardcore data on AI, again, we talked about it. Microsoft's doing 80 billion of CapEx spending this year, 45 billion last year. That is undeniable. And when you have that much level of investment in infrastructure going into what is this multi-level cycle around AI upgrades and AI infrastructure, it does seem like we are more bullish and bearish.